Welcome to the B.F. Anderson Technical Report for February 28th. I did want to make a comment about the recent Federal Reserve testimony by our latest Federal Reserve Chairman, Jay Powell. You know, it really is amazing the work that the Fed has been doing since Bernanke, Yellen, now Jay Powell. We've got an economy that is running well, meaning low unemployment, almost full employment basically, and inflation is low. I really think we are in a real good situation right now with the overall economy. So getting back to the market, let's look at the NASDAQ here real quick. We're still in an uptrend. Things are looking very positive here. Volume has not been extraordinary, but not bad either. It's been average volume. So it's been pretty much an average week. Now, the real good news here is that for the weekly indicator that we're using, we've now got 2 weeks, actually 3 weeks, above the 35-week moving average. You can see here also the weekly volume has been somewhat below average. Last week was way below average. This week looks like it's going to be below average as well. But we are in an uptrend, and we have broken above the 35-week, and the 35-week hopefully will turn up. Now, on the advanced decline line, we're still in an uptrend on the advanced decline line. We had a few net advancers yesterday. However, on Wednesday we had net decliners. We are looking good on the advanced decline line. Now, on the high-low index, the number of new highs are exceeding the number of new lows, and we're really in nosebleed territory here. This is somewhat of what we would call a blast off, which we'll talk a little bit more about here in a second. Number of new lows, we had 14 yesterday. You can see since the beginning of the year, the number of new lows have virtually dried up. This is very bullish. Now, on the long-term indicator, the 10-20, which is comparing the 10-month moving average to the 20-month moving average, we're now above the upper moving average. The upper moving average has turned up. We've got white space here. It looks like to me that the long-term trend of the market is up and is continuing. Now, this is a new indicator that I have learned about. It's published by the Chartist, which is out of California. He's a technical analyst, trend follower in California, ex-surfer. Interesting fellow. The rule is that when 90% of the stocks on the New York Stock Exchange or the S&P exceed 90% of the stocks above their 50-day moving average, that is a blast-off indicator. Now, there's only been 11 of these signals since 1970. And on average, the S&P is up more than 13% 6 months later. And then with all instances, 3, 6, and 12 months later, the market is up. And we got this signal on February 20th. So we're getting another blast-off indicator going for us here, which is the percent of stocks above the 50-day moving average exceeding 90%. Very, very bullish. Here we go. We've got the put-call ratio, which measures fear and greed. We are now in greed, which kind of tells you that the market is getting kind of hot. It is a secondary indicator, because the problem with sentiment is it can last for a long period of time. In other words, we could stay in greed for years. We could stay in fear for years. So it's just a secondary indicator. It just tells you that probably the easy money has been made here. Now, back to our original graph that we were looking at last week, where we're comparing the 100-day moving average to the 200-day moving average. And the purpose of this particular indicator is that we have gotten a death cross on this, which over the years has been a warning, but the warning is mediated by the fact that the 200-day moving average is flat and starting to turn up. So this is really not as negative as it could be, because if we were in a situation where the 200-day was doing this, we'd really not be looking too good. But the main area that we're looking at right now in the S&P is a breakout above 2,800, because that's the kind of the old resistance that we had from last year. Now, on the geometric index, again, this is a equally weighted index. We are still above the breakout box, which is very constructive. Now, on the top 5, we have some changes this week. Kind of things are changing. Here's an e-commerce situation. Etsy, they came out with earnings. The stock blew through the top. This is, a competitor to Amazon, and they're doing quite well. This is a software company called ServiceNow, been on the list for a while. These enterprise software companies are doing quite well. I think it ties into the 5G technology that's coming. But anyway, you can see here, broke out on earnings, skyscraper volume, making new highs, moving averages are up. ServiceNow looks very good. Now, we have stocks in our portfolio similar. Now, this is a company that's a medical tech company called Tandem Diabetics. They make a device that pumps insulin into a diabetic's body to help him with his disease. The stock announced earnings yesterday. Stock jumped 25%. Very strong. This is a stock that we own that's similar to ServiceNow. This is Workday. This is an enterprise software. They have not reported earnings. In fact, they report earnings this afternoon, so keep your fingers crossed. But when ServiceNow reported, their stock gapped up as well. Strong uptrend, recently made an all-time new high. Now here's our biggest position in the portfolio, a company called Xilinx Semiconductors. We're looking at a very strong uptrend here. This company makes programmable semiconductor chips that will be used in the 5G technology. So all in all the indicators are looking very positive. We have to take this a day at a time. And so today, everything looks good. So if you have any questions, give me a call. Thank you.